Billionaires don't get rich because they know some forbidden secret. They get rich because they follow rules so simple. Most people walk right past them. They never talk about these rules in public, but they repeat them quietly, almost mechanically, decade after decade. And today I'm bringing you the Bogle version, the 7 principles the ultra-wealthy live by, translated for the everyday investor. The best part? You don't need millions to use them. You need discipline, patience, and the courage to ignore the noise. So let's break the myth of the financial genius and expose the truth billionaires never bother to explain. And hey, if you want your wealth to grow the same way theirs does, slowly, quietly, and consistently, hit subscribe and drop a like. Call it your first tiny automated investment in the channel. Rule 1. They treat cost as something sacred. If you shadow a billionaire long enough, you'll notice something odd. They don't mind volatility. They don't panic about headlines. They're not obsessed with predicting recessions. But show them a hidden fee, a management charge, a bit of friction that siphons even a fraction of a percent out of their returns. And suddenly they turn into hawks, cold, sharp, laser-focused, because they know something most investors never bother to learn. Cost is the silent killer of compounding. Billionaires understand that every percentage point matters, not because they're miserly, but because they see the mathematical truth behind long-term growth. A tiny fee doesn't look dangerous in the moment. Maybe it's just 0.5%, maybe 1%. But stretch that same cost across decades, and it behaves like a slow leak in a ship. The vessel might still float for a while, but it will never reach the horizon with the strength it should have had. The compounding engine, the greatest wealth generator ever discovered, gets weaker with every drop of unnecessary expense. Jack Bogle spent his entire career shouting this from the rooftops. That's why he created index funds with rock-bottom expenses. And billionaires more than anyone understood the brilliance of that simplicity. They aren't seduced by glossy brochures or elite strategies with shiny branding. They don't confuse price with value. They know the scoreboard that actually matters. The return after all the fees have eaten their share. That number, the net return, is the only one that tells the truth. Behind closed doors, wealthy families negotiate every basis point. They negotiate fund fees, advisory charges, trading costs, lending spreads, currency conversions. It's almost obsessive, but it's an obsession grounded in arithmetic. When your money compounds for 20, 30, 40 years, a tiny difference becomes enormous. A 7% return versus a 6% return may look trivial on a chart, but over a lifetime, it can be the difference between comfortable and dynastic. And here's the twist. This principle isn't exclusive to people with private bankers. It's even more important for regular investors. Because if you only have a small amount to invest, the last thing you can afford is losing pieces of it to unnecessary friction. Wealthy people know that if markets are unpredictable and if returns vary, the one variable you can control is cost. So they control it ruthlessly. They also understand that Wall Street is a master at hiding fees behind complexity. The more complicated a product sounds, the more likely it is that someone is extracting value from you instead of for you. That's why billionaires gravitate towards simple structures. Index funds, broad exposure, low churn, low turnover, low drag. They want their money working, not leaking. They want to own the whole haystack, not pay a fortune to someone promising to find needles with a magic wand. This mindset extends far beyond investing. Wealthy individuals negotiate interest rates on loans even when they're symbolic. They push suppliers for better terms. They eliminate intermediaries. They refuse to pay for premium services that offer little more than polished marketing. They examine contracts the way a surgeon examines a tumor, searching for anything malignant that could grow quietly over time. The pattern is unmistakable. Money respects discipline, not drama. Those who treat cost casually end up working for their portfolio. Those who treat cost as sacred make their portfolio work for them. The irony is that the rule is entirely public. Every investor could follow it tomorrow, but most don't. The financial world runs on emotion, on hype, on fear of missing out. Billionaires run on spreadsheets and patience. They know that the enemy isn't volatility, or bear markets, or crashes. The enemy is erosion, the slow, invisible subtraction happening, whether you notice it or not. Control that erosion, and wealth becomes inevitable. Ignore it, and you'll spend your life sprinting just to stay in place. Rule 2. They buy the market, not the myth of the winner. There's a popular fantasy in finance that refuses to die. The idea that true wealth is built by discovering the next Amazon, the next Tesla, the next miracle stock hiding in the shadows. It's a seductive story because it feels heroic. It lets investors imagine themselves as visionaries spotting what the world has overlooked. But if you study the behavior of the ultra-wealthy, you'll notice something striking. They don't play that game. In fact, they avoid it. Billionaires aren't chasing lottery tickets. They're not digging through stock charts at 2 a.m. searching for the next rocket ship. They don't need to. They understand a fundamental truth that Jack Bogle spent his life repeating. You don't need to find the needle when you can simply own the haystack. The wealthy know that markets are brutally efficient at one thing, identifying winners over time. Not in a single day, not in a single month, but across years and decades. Companies rise and fall, trends come and go, heroes become villains, and disruptors become disrupted. But the market as a whole adapts, evolves, and continues climbing. By owning everything, you guarantee you own the winners. And by owning everything, you guarantee you're protected from the losers. It is the ultimate asymmetric strategy. The myth of the next big winner survives because it feeds human ego. Everyone wants to feel clever. Everyone wants to believe they've uncovered a hidden gem before the crowd. But billionaires think in probabilities, not fantasies. They look at history, not headlines. And history shows something brutally clear. A tiny minority of stocks generate the majority of the market's long-term returns. Miss those few winners and your portfolio collapses from promising to disappointing. Capture them, and you don't need brilliance, just broad exposure. This is where index funds become the quiet, unglamorous heroes of real wealth creation. They don't promise miracles. They don't deliver adrenaline. They don't make for exciting cocktail party stories. But they provide something far more powerful: inevitability. They ensure you own the future giants long before anyone knows they're giants. No guessing, no gambling, no self-appointed stock guru whispering predictions. And here's what many people never realize. Billionaires often use index-like strategies even when they're investing through private vehicles. They diversify aggressively across industries, sectors, geographies, and asset classes. They don't bet the farm on any single narrative. They spread their exposure wide enough that the outliers, the companies that defy gravity and reshape entire sectors, are automatically in their basket. They don't have to find them. They just have to hold them long enough. Bogle's haystack metaphor is more than a clever line, it's a worldview. Searching for needles invites overconfidence, emotional decisions, and costly mistakes. Owning the haystack invites humility, consistency, and long-term victory. Billionaires choose the second path not out of laziness, but because they understand that the market is smarter than any individual, and it works for anyone patient enough to trust it. What's fascinating is how counterintuitive this looks from the outside. People assume the wealthy must have some superior information, some hidden insight, some VIP access that lets them cherry-pick winners. But in reality, most of them don't bother trying. They take the opposite approach. They step back, zoom out, and let the entire market carry them. Because in the end, the secret isn't predicting the future. The secret is owning the future. And the simplest way to do that, the way that has quietly built fortunes for decades, is by owning the whole haystack, year after year, while everyone else exhausts themselves trying to outsmart probability. Rule 3, patience is a strategy, not a virtue. If you watch how everyday investors behave, you'll see a rhythm that never changes. Markets move up a little, and people rush in. Markets dip, and people scramble out. A headline appears, and sentiment flips overnight. The average investor thinks in days, sometimes hours, because the world has taught them that reacting quickly is the same as being smart. But if you quietly observe the ultra-wealthy, you'll notice something almost unsettling. They hardly move at all. Billionaires don't treat patience as a moral trait. They treat it as a weapon, a strategy, an edge, something intentional, not accidental. They understand that the market doesn't reward the frantic. It rewards the persistent. It gives its greatest gifts to those who simply have the discipline to sit still long enough for compounding to unfold. Most people imagine compounding as a smooth curve, a gentle rise that begins the moment you invest. But that's not how it works. Compounding is lumpy, uneven, stubborn. It punishes the impatient and tests the faithful. In the early years, it feels like nothing is happening. The line barely moves. But over decades, the curve bends upward with a force that looks almost supernatural. And that bend, the explosive part, only arrives for those who refuse to interrupt it. This is where the ultra-wealthy separate themselves from everyone else. While the public jumps in and out of the market, trying to sidestep discomfort, billionaires sit through storms. They sit through noise. They sit through boredom. They don't confuse temporary volatility with permanent loss. They know that the real destruction comes not from downturns, but from abandoning a strategy in the middle of one. Jack Bogle often said that the stock market is a giant machine designed to transfer wealth from the impatient to the patient. The wealthy understand this intuitively. They don't judge their portfolio by what it does this quarter or even this year. They're looking at decades, 20, 30, 40 years into the future. They're thinking about generational outcomes, not weekend headlines. That time horizon alone gives them a mathematical advantage that is almost impossible to compete with, because impatience has a cost, a massive one. Every time an investor sells out of fear, they risk missing the market's sharpest recoveries. Every time they rotate into the hot sector, they expose themselves to the highest valuations and the lowest future returns. The cycle repeats endlessly: fear, reaction, regret. Meanwhile, the patient investor quietly rides the long-term trend, collecting the full compounding effect that others keep interrupting. The wealthy also understand that volatility isn't a signal to act. Volatility is the admission price of long-term growth. Markets wobble. They drop unexpectedly. They surge irrationally. That's not a flaw. It's the system functioning exactly as it always has. Billionaires accept this reality instead of fighting it. They separate emotional noise from financial truth. what most people call risk, billionaires call time doing its work. They know that every period of discomfort contains seeds of future reward. Historically, the market has always recovered, always pushed to new highs, always rewarded patience, not immediately, not smoothly, but inevitably. This mindset explains why the wealthy rarely chase the quick win. They don't need to. They don't want to. They're playing a different game entirely. A slow game, a deliberate game, a game where the biggest victories happen quietly, unnoticed by those too busy checking daily price charts. For them, patience isn't passive. It's the most active decision they make. It's choosing not to flinch, not to chase, not to abandon a plan for the illusion of control. It's the realization that wealth is a long conversation between you and time only speaks to those willing to listen long enough. In a world addicted to immediacy, billionaires profit from delay. In a culture obsessed with speed, they win by standing still. And in a market full of people trying to outsmart each other, they gain the ultimate advantage simply by refusing to interrupt the compounding that everyone else keeps sabotaging. Rule 4. They automate what makes everyone else anxious. Most investors live in a constant state of emotional turbulence. They buy when they feel hopeful, sell when they feel scared, freeze when headlines scream, and rethink everything whenever the market turns red for a single day. Their financial decisions rise and fall with their mood, like a ship with no anchor. But billionaires, they operate differently. They don't rely on willpower or nerves of steel. They build systems that make decisions for them, especially when their emotions threaten to take over. The ultra-wealthy understand that humans are terrible under pressure. Neuroscience has already proven it, but billionaires didn't need a study to figure it out. They know that fear, excitement, greed, and stress distort judgment. They know the mind becomes unreliable in the heat of the moment. So instead of trying to conquer emotion, they remove it from the equation entirely. They automate. They automate contributions so money flows into investments, whether markets look calm or chaotic. They automate diversification, spreading their exposure across sectors and geographies without having to feel good about it. They automate rebalancing, selling what's grown too much, buying what's lagged. Not because it's easy, but because it's the opposite of what emotion wants to do. And they automate their rules around risk, when to hold, when to trim, how much to allocate, and how much volatility they are willing to endure. This isn't laziness, it's strategy. It's the understanding that a system behaves better under pressure than a human being ever will. Jack Bogle knew this better than anyone. He built investment vehicles that function like machines, consistent, predictable, unemotional. Index funds don't wake up nervous. They don't panic when inflation spikes or when the Fed speaks. They don't care who wins the election. They simply follow the rules they were designed to follow. And billionaires adopt that philosophy in every corner of their financial lives. Most people underestimate how much this matters. They think discipline comes from motivation or personal strength. But billionaires know that discipline comes from removing decisions, not forcing them. Every manual decision introduces hesitation. Every hesitation introduces emotion. And emotion introduces error. Automation is the antidote. Consider how the wealthy approach volatility. When markets fall sharply, ordinary investors feel the urge to do something, anything, to relieve the discomfort. They sell at the worst moments, rotate out of fear, second-guess themselves, and rewrite their strategy on the fly. But billionaires have already built instructions for these moments. They don't have to act impulsively. Their system acts for them. Whether it's a predetermined buying plan, a risk allocation formula, or a simple stay the course rule embedded into their strategy, they rely on structure rather than adrenaline. Automation also removes the need for constant monitoring. Regular investors exhaust themselves checking prices, reacting to every dip, obsessing over fluctuations. But systems allow the wealthy to detach emotionally. They don't check obsessively because they don't need to. They trust the process they designed. They know that success doesn't come from reacting, but from consistently applying a strategy that compounds over time. And here's the profound insight. Automation is not about being hands-off. It's about being hands-on once, with clarity, intention, and logic, and then letting that plan run without interference. Billionaires put enormous effort into building the right system, because once the system is built, the system protects them from themselves. They automate their strengths and their weaknesses, their discipline and their doubts, their ambition and their fear. The structure carries them through storms that would overwhelm most investors. In the end, what separates them isn't intelligence, it's architecture. They design a financial life where emotion cannot sabotage the outcome. The market can move wildly, the world can shift unpredictably, and their portfolios continue marching forward, not because they are fearless, but because they never give fear a chance to take the wheel. Automation is their shield, their compass, their silent partner. And in a world where most investors lose the battle against their own impulses, billionaires win simply by refusing to fight that battle at all. Rule 5. They never confuse noise with information. If you want to understand why most investors struggle, you don't need to study their portfolios. Just watch how they react to the news. A headline flashes across the screen, and panic spreads. A commentator raises his voice, and people adjust their strategies. A prediction goes viral on social media, and suddenly everyone feels compelled to take action. The world bombards investors with constant noise, urgent, emotional, overwhelming. And most people mistake that noise for insight. Billionaires don't. The ultra-wealthy have a fundamentally different relationship with information. They don't consume it for excitement, validation, or entertainment. They treat information like a scarce resource, something to be filtered, weighed, tested. They know that in markets, as in life, the loudest signals are often the least useful. Real information rarely screams, it whispers, and the wealthy have trained themselves to listen only to what matters. They filter relentlessly. They ignore market forecasts because they know no one consistently predicts the future. They disregard sensationalist headlines designed to provoke fear or greed. They don't let a TV expert's confidence fool them into believing a story with no statistical backbone. They understand that opinions echo everywhere, but data, real, durable data, is rare. Jack Bogle spent decades cutting through this noise. He warned investors that media cycles profit from attention, not accuracy. The wealthy internalized this wisdom long ago. They view financial news like weather reports, dramatic, changeable, and often wrong. Instead of reacting to every gust of wind, they build a sturdy house and let storms pass. This ability to ignore noise gives them clarity in moments when others lose it. When markets fall sharply, headlines feed panic. Words like collapse, crisis, and meltdown appear in bold across screens. The average investor feels pressure to act, to escape the imagined freefall. But billionaires don't see a crisis, they see volatility, which is simply the natural breathing pattern of the market. They separate the emotional tone of the news from the underlying reality. And when markets soar, the noise becomes euphoric, predictions turn rosy, Experts claim a new era of endless growth. Retail investors chase momentum, convinced that this time is different. But billionaires maintain their skepticism. They know exuberance distorts perception just as much as fear. Noise doesn't only panic investors, it seduces them. Instead of being pulled by these emotional extremes, billionaires rely on frameworks. They look at fundamentals, long-term trends, valuations, broad economic data. They prefer spreadsheets to sound bites. They evaluate information based on reliability, not entertainment value. If something doesn't influence their long-term strategy, they discard it instantly. This disciplined filtering isn't cold or robotic, it's protective. Noise triggers impulsive actions, buying too high, selling too low, rotating unnecessarily, overtrading, second-guessing. Every emotional decision chips away at returns. Every reaction to noise introduces errors. Over time, these errors compound in the wrong direction. Meanwhile, those who focus on signal, actual information, let their portfolios grow untouched by the chaos of commentary. The wealthy also understand that most predictions are just narratives dressed as certainty. A confident voice doesn't make a forecast accurate. A dramatic chart doesn't make a claim meaningful. If the information doesn't contain statistical evidence, historical context, or real probability, billionaires classify it as noise and move on. This saves them from the trap most investors fall into, mistaking motion for progress. Their detachment isn't ignorance, it's intentional. They choose what enters their mind. They curate their inputs the same way they curate their investments. By limiting noise, they preserve mental clarity. By preserving clarity, they make better decisions. And by making better decisions, they consistently outperform investors who spend their days reacting to every headline. In the end, the difference between noise and information is the difference between anxiety and strategy. The crowd listens to the market's daily chatter. Billionaires listen to its long-term truth. And that truth is quiet, steady, data-driven, and indifferent to drama. The wealthy don't have special information. They simply refuse to be misled by the noise that distracts everyone else. Rule 6. Discipline beats talent. There's a romantic idea floating around the world of investing, the idea that great wealth comes from brilliance, that somewhere out there, fortunes are built by prodigies who can read markets the way others read sheet music. And while this story sounds inspiring, it's mostly fiction. If you look closely at the habits of the ultra-wealthy, you'll notice something far more ordinary and far more powerful. They aren't relying on raw talent. They rely on discipline. Talent reacts. Discipline endures. Billionaires don't pretend to know what the market will do next week, next month, or even next year. They understand that no amount of cleverness can predict short-term chaos. Instead, they create a plan grounded in long-term principles and then stick to that plan with a kind of stubborn consistency that most people find impossible. That consistency, more than intelligence, is what separates them from everyone else. When markets fall, the average investor becomes emotional. Fear rises, confidence evaporates, and doubt takes control. Headlines amplify the panic. Friends start whispering about selling, and internal alarms scream for action. It's at this exact moment, when everything feels wrong, that discipline becomes the difference between building wealth and destroying it. The wealthy hold their ground. They don't abandon their strategy because of temporary discomfort. They don't sell in a frenzy because prices are falling. They don't rewrite their entire philosophy because a chart turned red. They trust the mathematics of long-term returns, the history of recovery, and the compounding engine that demands time, not talent, to work properly. They understand that the biggest gains occur after the hardest moments, and that exiting at the bottom is one of the costliest mistakes an investor can make. This ability to stay the course isn't glamorous. It doesn't feel clever or heroic. It feels quiet, almost boring. But it's precisely that quiet persistence that builds fortunes. Markets reward those who remain invested when others flee. They reward those who ignore the emotional storms that toss the crowd around. They reward those who can tolerate uncertainty without rewriting their entire playbook. And ironically, the more volatile the environment becomes, the more valuable discipline gets. In turbulent periods, talent becomes almost useless. Intuition breaks down, predictions fail, and brilliant minds make catastrophic errors trying to outsmart the chaos. But discipline simply keeps marching. It doesn't need accurate forecasts. It doesn't need perfect timing. It just needs commitment. Jack Bogle understood this deeply. He often said that the stock market is a test of character, not intelligence. The wealthy embody that truth. They don't need to outperform the market through genius. They just need to avoid underperforming it through emotional mistakes. They know that sticking with a good plan, even an unexciting one, beats jumping between great ideas executed inconsistently. Discipline also protects them from the seduction of trends. When the crowd chases the latest hot stock, billionaires stay grounded. When everyone becomes obsessed with speculative assets, they remain skeptical. When hype convinces millions that a bubble has no ceiling, the wealthy rely on fundamentals instead of fantasies. This steadiness creates a compounding effect far more powerful than any single investment decision. It's the accumulation of thousands of tiny stay-the-course moments. It's the refusal to panic, the refusal to chase, the refusal to abandon long-term logic in the face of short-term emotion. The irony is that the wealthy often look more intelligent, simply because they appear calm when everyone else is melting down. But what looks like genius is just practiced discipline. They've trained themselves to endure discomfort, to separate feeling from strategy, to remain loyal to their principles even when markets punish them temporarily. They understand that turbulence is temporary, but discipline is permanent, if you choose to make it so. Talent may give you flashes of brilliance. Discipline gives you decades of results. And in a game where wealth is built slowly, quietly, and relentlessly, decades matter far more than flashes. Rule 7. Wealth is built by avoiding mistakes, not by being a genius. There's a strange misconception about wealth, that the people who reach extraordinary financial heights do so by making brilliant, high-risk decisions that the rest of the world is simply too slow or too naive to recognize. But if you study the habits of billionaires, you'll find almost the opposite. They don't wake up each morning hunting for dazzling opportunities. They wake up trying to avoid stupidity. Their mindset isn't, how can I be a genius today? But how do I make sure I don't sabotage myself? Jack Bogle said it plainly. Avoiding mistakes is the most underrated strategy in finance. Billionaires have internalized this. They understand that markets are already powerful engines of growth. You don't need brilliance to benefit from them. You need to stay out of your own way. For most investors, the biggest threat isn't missing the next big winner. It's making preventable errors that quietly eat away at returns. Overtrading, chasing trends, timing the market, panic selling during downturns, overpaying for exotic products, or following someone else's excitement instead of a long-term plan. These mistakes compound in the wrong direction, turning even decent portfolios into disappointing ones. The wealthy operate differently. They aim for high probability outcomes. not heroic victories. They prefer steady returns over spectacular ones. They structure their portfolios to survive downturns instead of trying to dance around them. They diversify widely because they know concentration brings brilliance only when you're right, and catastrophe when you're wrong. And they would rather be consistently right in a small way than occasionally right in a big way. This mindset creates a fascinating contrast. While the average investor is busy imagining the next life-changing trade, billionaires are quietly eliminating unnecessary risks. They avoid leverage unless it serves a clear, controlled purpose. They avoid emotional decisions. They avoid products they can't fully understand. They avoid managers who sound charismatic but can't demonstrate long-term discipline. And above all, they avoid the temptation to drift from their strategy when markets get turbulent. Avoiding errors sounds passive, almost timid, but it's incredibly powerful. It's like sailing. You don't need to catch every gust of wind to reach your destination. You just need to avoid sinking. Billionaires understand that the surest way to get rich is first to avoid getting poor. This philosophy also frees them from the toxic pressure of trying to beat the market. They don't need to outperform. They just need to capture the market's natural long-term return without cutting it in half through bad behavior. They know that a portfolio untouched by self-inflicted wounds often performs better than one managed by someone chasing brilliance. The irony is that avoiding mistakes requires its own type of intelligence, not intellectual intelligence, but emotional intelligence. It takes humility to admit that you don't know where the market is going. It takes restraint to stay invested during frightening downturns. It takes maturity to ignore seductive stories about overnight riches. And it takes wisdom to accept that the simplest approach is often the most effective. Billionaires are not immune to fear or greed. They just refuse to let those emotions dictate their actions. They build structures, rules, systems, allocations that prevent catastrophic mistakes even when their instincts beg them to do something impulsive. Their wealth is protected not by brilliance, but by guardrails. In the end, the wealthy don't win because they make extraordinary decisions. They win because they avoid disastrous ones. They're not trying to be exceptional. They're trying not to be foolish. And in a world where the average investor keeps tripping over the same emotional traps, that alone becomes a massive competitive advantage. Great fortunes aren't built by chasing greatness. They're built by sidestepping the landmines that destroy everyone else's compounding. When you strip away the headlines, the mystique, and the mythology around wealth, something becomes strikingly clear. These 7 rules aren't reserved for billionaires. They're not locked behind private banking doors or accessible only to people with yachts and family offices. They're ordinary principles disguised as extraordinary outcomes. What separates the wealthy from everyone else isn't access, it's behavior. Every rule you've heard, protecting costs, buying the whole market, practicing patience, automating decisions, filtering noise, choosing discipline over talent, and avoiding avoidable mistakes, rests on the same foundation, self-control. The wealthy don't win because they're smarter. They win because they're steadier. They take the simple path and actually stay on it. They repeat the boring steps with religious consistency. They let time be their ally instead of their enemy. Most people could do the same, but most people won't. Not because it's complicated, but because simplicity demands humility, patience demands emotional strength, and repetition demands commitment long after excitement fades. These rules only look like billionaire wisdom because so few are willing to follow them long enough for the results to show. Wealth in the end is not the product of secret formulas. It's the accumulation of small, rational decisions made over decades. It's not built by genius. It's built by refusal. The refusal to chase, to panic, to overreact, to abandon the plan when it feels inconvenient. Anyone can do that. Anyone can build that mindset, but it requires the one thing that can't be bought: self-discipline. If these principles resonate with you, if you feel that quiet shift inside, that sense that the long-term game is finally starting to make sense, then stay with this journey. Subscribe, leave a like, and keep learning. Call it your first act of financial self-control today.